The world's most critical oil route is under immense pressure. As markets brace for Monday, every trader is asking, is this the calm before a storm? Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. Starting with the biggest updates from the last 24 to 48 hours. Fresh talks in Islamabad are happening right now. These are crucial negotiations. However, Iran says it will not accept maximalist demands. This means while talks are active, no final breakthrough has been reached yet. So we are in a stalemate. The diplomacy is weak, and the market remains on edge because the risk premium isn't fading. The Strait of Hormuz is still the main issue. As the world's most important oil shipping route, any tension here disrupts global flows. Flows remain disrupted, and markets are aggressively pricing risk into oil. If this lane is blocked, the global impact will be immediate. Importantly, there has been no confirmed major new direct attack in the last 48 hours. This reduces the immediate panic risk for Monday. While no large fresh missile headlines have appeared, the markets remain sensitive. A single headline on Sunday could change everything. But make no mistake, military pressure continues. Naval blockades and interception risks remain elevated as we head into the new week. Shipping tensions are high. Traders are braced for any surprise Sunday headline that could trigger a gap down in global markets. Looking at yesterday's commodity close, Brent crude finished at $105.33 and WTI crude at $94.40. This is a massive weekly move. Brent is up 17% and WTI is up 14% for the week. This is one of the biggest weekly spikes in months. Gold is also telling a story of fear. Spot gold is currently trading at $4,135.65 per ounce. Safety demand is high. US gold futures are even higher at $4,653. Investors are clearly hedging against a potential escalation in the geopolitical situation. When Brent stays above $100, inflation fear dominates. Transport costs rise, fuel prices rise, and input costs for all industries increase. This pressure eventually reaches the consumer. Central banks stay cautious, and stock markets become volatile as investors recalibrate their expectations. The elevated gold price means markets want safety. This safety demand signals that the smart money is prepared for more volatility ahead. Now let's map out the global market impact for Monday. We have three scenarios based on the probability of events. The bullish scenario has a 45% probability. This happens if there's no new weekend shock and oil cools toward $100. This would spark a relief rally. Banking, IT, and consumer names would likely lead the market higher as panic subsides. The second scenario is range-bound at 35%. This occurs if there's no deal but also no direct fresh attack. The market becomes choppy. Energy remains strong, but other sectors are mixed as investors struggle to find a clear direction. The bearish scenario is at 20%. This is triggered by a Sunday surprise strike or a total collapse in diplomatic talks. If the Hormuz situation escalates and oil spikes above 110, we could see a significant global gap down on Monday morning. For the Indian market, the impact depends on oil stability. If oil is stable, we expect a positive opening for IT and private banks. IT, private banks, FMCG, and telecom are likely to lead. These sectors thrive when macroeconomic oil pressure is low. However, if oil jumps, we have clear risk sectors. Paints, aviation, auto, and logistics will face immediate selling pressure. Chemicals and logistics are particularly vulnerable due to high dependency on crude prices and transportation costs. Expect high volatility? The winners in a high oil scenario are energy and upstream oil companies. Utilities and select PSUs will also see buying interest. Let's look at the headline-worthy items. Oil exploded this week. This is one of the biggest weekly moves in months. The situation at the Strait of Hormuz is not normal. Despite talks, supply chains are still feeling friction and significant delays. There is a ceasefire, but it feels temporary. This is why markets aren't fully trusting the current stability yet. Dollar strength is also returning. Geopolitical stress and firm oil prices helped the dollar gain strength this week. Here are the levels for Monday. For oil, watch $100 Brent as support and 107.5 as resistance. Watch these closely. For gold, support is 4,700 and resistance is 4,800. A break above resistance signals a new wave of market fear. On the Nifty, the framework is simple. Stable oil means upside attempt, while an oil spike leads to immediate profit booking. As a trader, here is your summary. We are not in collapse mode, but we are not in safe mode. We are in a high volatility environment. Talks are ongoing, oil is expensive, and weekend headline risk is real. The best strategy right now is to stay disciplined. Diving deeper into the Islamabad dynamics, the problem is the gap between offerings and demands. It's a strategic stalemate. The insight is that Iran's refusal isn't just rhetoric, it's a strategic position that could prolong uncertainty for weeks. The Strait of Hormuz is a choke point. Geography is destiny here. If this closes, the global energy economy stops. The realization for traders is that energy security is not guaranteed. This volatility is a wake-up call for diversification. The takeaway: do not trade on emotion. Wait for levels to be tested and watch the headlines out of the Middle East. To understand today, we must look at history. Oil shocks in the 1970s showed us how energy costs can reshape entire economies. Every time energy prices spike, we see a structural shift in how businesses operate and how central banks manage liquidity. In 2008 and 2014, India faced similar oil pressures. The market's resilience depends on how quickly policy can adapt. Today, India is better prepared with larger strategic reserves, but the immediate fiscal impact on the rupee remains a concern. The link between oil and the Indian rupee is critical. As oil prices rise, India's trade deficit widens, putting pressure on the currency. A weaker rupee makes imports even more expensive, creating a feedback loop of inflation that the RBI must manage through intervention. Technically, Brent is testing major resistance levels. We are looking for a double top pattern or a sustained breakout above 107.5. Gold's chart shows extreme safety demand. A break above 4,800 would be a significant technical signal for further upside in safe havens. Are there alternatives to the strait? Pipelines and land routes exist, but they cannot currently match the volume of maritime trade. Rerouting around Africa adds weeks to transit times and significantly increases freight costs, which eventually impacts the final oil price. Consider a manufacturing firm in India. A 10% jump in oil can erode their entire operating margin within a single quarter. This is the real-world impact. When energy costs spike, companies are forced to either absorb the loss or hike prices, risking lower demand. So, how do you protect your portfolio? In high volatility modes, cash is often a valid position until a clear trend emerges. Diversification into non-oil sensitive sectors and safe havens like gold can provide a buffer against sudden market shocks. Tighten your stop losses and manage your position sizing. Do not over-leverage yourself when headline risk is this high. Let's focus on IT. This sector is a natural hedge because much of its revenue is in dollars, which strengthens when oil rises. Private banks with strong balance sheets also tend to be resilient, provided interest rates don't spike too aggressively. FMCG companies with strong pricing power can pass on transport costs to consumers, maintaining their margins in a high inflation environment. In contrast, the paint industry is highly sensitive. Raw material costs are directly linked to crude oil prices. Expect margin pressure. Aviation is also at risk. Fuel is the largest expense for airlines. A sustained oil spike can quickly turn profits into losses. The auto sector faces dual pressure: rising input costs for manufacturing and lower consumer demand as fuel prices rise at the pump. The lesson here is interconnectivity. A geopolitical event in the Middle East impacts a consumer's wallet in India within days. Energy is the lifeblood of the global economy. Understanding its movements is the key to anticipating broader market trends. While oil is the current focus, the global energy mix is shifting. This volatility often accelerates the transition to renewables. However, for the next few years, fossil fuels remain the primary driver of market sentiment and inflation globally. For the retail trader, the best advice is to remain humble. The market can remain irrational longer than you can remain solvent. If the volatility is too high for your risk tolerance, it is perfectly fine to sit on the sidelines and observe. Preservation of capital is a win. In the midst of chaos, your greatest asset is your discipline. Do not let the noise of the headlines dictate your long-term strategy. Analyze the data, watch the levels, and make decisions based on facts, not fear. This is how successful traders navigate volatility. If this explanation helped you see things a little more clearly, that is exactly what this channel is meant for. We will continue breaking down finance and insurance concepts step by step in a way that feels practical and manageable. If you find this helpful, please like the video, subscribe to the channel, turn on notifications so you do not miss future videos. Thank you for being part of the Yearn to Grow community.